Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe and click the bell so you get a notification of when we're releasing a new video. I'm sitting today with Willie Pelser. It's good to be back in the seat. We were, I see it was there was a takeover happening with some of the young guys, so it's good to be
it's
back
nice
with
to
you.
see the team on operation.
Absolutely, and it's nice for the viewers to see the team we're building in the background, Willie, which is great.
No, that's awesome.
Willie, so I think we got a big shock, first of all, when we saw the inflation number, and I think we had all got out our pens and written an increase of 25 basis points, and then the governor surprised us. And then we thought we were in big trouble because we absolutely knew the US was going to raise rates, and he also surprised us. So now I'm totally confused. I think you need to help me here, please.
Robin, I think I'm also confused, and it's because if we consider economics 101, that was a surprise because both had to sort of raise rates, and if I say they, I refer to the institutions and not the individuals, but they are run by individuals. So let's quickly go back to South Africa's numbers. Yes, we came out, I think 4.5% was the print. We were sitting in as a management meeting when it popped up on the screen, and we said, okay, hike tomorrow. Like everybody's saying, all economists in the country were wrong because they all said it's going up. So why didn't they hike? Robin, that's a $1 million question actually. Four of the members said no, and two were obviously adamant that we had to do this. So I think this is, Lusecha put it into a little bit of perspective in the meeting minutes or the team. So what they're looking at is obviously their own models. And their own models plus, we've spoken about this before, we want to get to 3%. So we were at 4.5, so just take it into account. So if you think 4.5. But what they were saying is, if we look at the transitionary effect, then they still have in their own models that we can get a 25 basis points hike. So it's not that they were not considering the effect of inflation going forward, but what they were saying is, yes, if we have another opportunity to hike, we will definitely do it. Okay. But this one was probably just a bit too quick from what they were looking at. So what were they looking at? They were looking at the Bureau of Economic Research published that inflation expectations going forward into the next 3-4 years. They were still at sort of 4% on average over the period. I'm just averaging here. Yeah. And their own model was just slightly below that. Okay. So I think what they then said is, if we look at that, we don't see a serious hump. Okay. Also consider oil is volatile, the war is volatile, and I think they just rest a little bit. Deep underneath, and that's my own thinking about pockets in the economy being wallets and spending power. Yes. Maybe there was a subtle feeling of, if we hike another time now, we're really going to kill the consumer. That's maybe a hope from my analysis perspective why they didn't. Yes. What happened was actually a disaster from a rand perspective, because the rand blew out to 1672. I think it was 84 intraday.
But that's to be expected, because if you're expecting America to hike and we don't hike, then the spread grows.
Exactly, and not just the spread, because if you don't hike now, you're not fighting future inflation. So the rand said, okay, we take it. Not going to delve into what happened on the bond market. It was also some very interesting moves on the areas on the yield curve, which was to be expected. A lot of fund managers, and I listened to quite a few of them on Wednesday, were caught on the wrong side, especially active funds were caught on the wrong side on the curve. Okay, let's jump over the ocean. Which one is this? Atlantic. The Reserve, the central bank in the US, or the Federal Reserve, was probably the one that surprised all over the world. Yes. Very interesting in the minutes afterwards, in the conversation actually, the governor there referred to US inflation should be around 2%, 20 times in the speech, which again, if they're aiming for 2, but they're not there, why didn't they raise interest rates? And he tested the market very, very interestingly. Remember in the US, the repo rate or the sort of prime related rate is not the only reference rate. The 30-year government bond is used in the home loan environment.
Yes.
And he was basically saying, listen to what I'm saying and don't only look at what I'm doing. And he was referencing the fact that the long end of the yield curve has been constantly rising, obviously on an expectation that inflation is going. So on a real rate perspective or impact rate perspective, the interest rates are actually doing what he's hoping to do when he raises interest rates.
Okay.
So it's a different dynamic if you look at it from that perspective, and that's the main reason they haven't hiked.
Yeah. So to be clear, for the sake of the viewers, what I'm understanding you saying is that because home loans work on that floating rate of the 30-year bond in America, effectively that's already been doing the work that the central bank needs to do.
So effectively, if the bank wanted to raise rates on the global populace within America, they already had a rate hike. In the sense they have to adjust their sort of loan rates. So that's already a mechanism that's in place. Yes, again, there's some very interesting dynamics in the bond market in the US from vigilantes and so on, because when you start talking, especially when you try and defend a currency or try and defend a move, you can call out the speculators and so on. So I'm not going to delve into that. So back, Robin, I think in context, both scenarios is the South African and the international. I see this morning Bank of Japan has also kept rates unchanged. I think they're leaving it up to the other powers in the economic systems to do the work for them. Lower spending doesn't push inflation higher because there's a lack of demand, that type of thing. So I think there was a bit of sanity. Yes, a surprise factor is always a surprise factor because someone was on the wrong side of the trade.
Yeah.
And also if on average everybody is expecting it, then it's still a surprise. Yeah. It doesn't stop any of those, given the inflation scenario and the volatility in the oil price, that they will move in the next meetings and so on. So I don't think we're at the high when it comes to the interest rate cycle. It does have an impact. We've mentioned it before. So if your interest rate level remains high, that leads into the volatility on the equity markets because that's your pricing mechanism. So I think it's just another 3, 4, 5, 6 months or until year end where volatility will be the game.
Yeah. So. And Willie, just quickly, we're pretty much out of time, but the other thing to say is, markets always get shocked with geopolitical events. So, I mean, if we go back and we look at the Ukraine war and what that caused across markets at the time, I mean, I think that's 4th page news now and almost is in the base. It feels to me like US-Iran they're going to trade missiles for a long time to come. It's now moved to 2nd or 3rd page news, and we're absorbing this into the equation. Let's worry more about what's happening with AI expenditure.
Robin, that's what an economic system does. It corrects itself. So yesterday, Amazon announced that they've had 600 billion whatever refunds on the tariff system. So that's now going back. What they're saying is they're going back to suppliers or consumers. So that's the pricing mechanism over time. That's just one example where it corrects. And the same will happen with oil, alternative energy and those things. So.
Awesome. Well, Willie, thanks for giving us those insights. Thank you for joining. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.